today. The calibration phase for inflation is now in hand. Hello again, it's Martin North from Digital Finance Analytics, World Latest Post covering finance and property news. Well, the outgoing RBA Governor Philip Lowe said that the central bank was now in a calibration phase where rates were in restrictive territory and further adjustments will only result from data surprises. This was part of the discussion in the House Economic Committee, which met to review the RBA's annual report on Friday. While persistently high services inflation meant the RBA retained a tightening bias, Dr. Lowe pointed to the emerging China economic slowdown as a new downside risk to the inflation outlook. Overall, he said it was encouraging that recent data was consistent with inflation returning to the RBA's 2 to 3% target by 2025, adding to expectations the central bank is at the start of an extended cash rate pause.
The RBA's main focus over the past year or so has been to get on top of the highest inflation in more than 30 years. We've made progress here and things are moving in the right direction, but it's still too early to declare victory. At the previous hearings, I spoke about why it was so important that inflation returns to target within a reasonable time frame and that this episode of high inflation is only temporary, and I'd like to reinforce that message today. High inflation is corrosive to the healthy functioning of our economy, and it makes life difficult for everybody, especially those on low incomes. Inflation increases income inequality and it eats away at people's hard-earned savings. And if high inflation does become ingrained in people's expectations, history teaches us very clearly that the end result is even higher interest rates and even greater unemployment to get inflation back down again. It's for these reasons that the RBA is resolute in its determination to return inflation to the 2 to 3% target range within a reasonable time frame, and we will do what's necessary to achieve that outcome. Inflation in Australia peaked late last year at 7.8%. Since then it's declined to 6% and we expect further declines over the quarters ahead. Our central forecast is for CPI inflation to be around 3.25% by the end of next year and to be back within the 2 to 3% target range by late 2025. Within the aggregate figures, though, there are divergent trends, as there are overseas. Goods price inflation has slowed considerably as supply chain issues have been resolved and the demand for goods has eased. But in contrast, the prices of many services are continuing to increase strongly, and there's quite a lot of upward momentum in rent price inflation. There are also large increases in electricity prices taking place in many parts of the country. Another common feature internationally is that the high level of demand for goods and services has meant that labour markets have been resilient and they remain tight. Here in Australia, employment growth has been strong and the unemployment rate has been close to 3.5% for a year now. That's the lowest level of unemployment for almost half a century. The participation rate's also at a record high and many women and young people are benefiting from this. And this is one of the positive legacies of the policy response to the pandemic, and in my view it's something we should all be welcoming. Low unemployment is good for our society and for our economy, and we should welcome the lowest unemployment rate in 50 years. The recent data indicate that there has been some easing in the labour market, with firms reporting to us through our liaison program that it's less difficult to find workers than it was late last year. Nonetheless, employment growth is still strong at a time of rapid population growth. We expect employment to continue to grow, but to grow below the rate of growth in the labour force. As a result of that, the unemployment rate is forecast to rise gradually over the next year or so to reach around 4.5% by late next year. The Australian economy is currently experiencing a period of below-trend growth, and this is expected to continue for a while yet. Many households are facing a painful squeeze on their budgets, and consumer demand has slowed considerably, not least because high inflation is eroding people's real incomes. The increase in interest rates is also weighing on disposable incomes for many households, although others are benefiting from higher interest income earned on their savings. The RBA staff are working hard to look beyond the aggregate figures and to understand the financial pressures that people are experiencing and where they're most acute. It's clear that some households who borrowed at lower interest rates during the pandemic are finding conditions very difficult, as are some renters at the moment, and we're doing our best to understand these pressures. Looking forward, the bank's central scenario is that economic growth remains subdued for the rest of this year before gradually picking up to around 2.25% by the end of 2025. The ongoing moderation in inflation will mean that real incomes start rising again, and this will ease the financial pressures that people are facing. Business investment has also been on an upswing as firms respond to pressures on capacity utilisation, and dwelling investments expected to increase again next year after the recent difficulties in the residential construction sector.
All the evidence is that it takes time for monetary policy to fully work its way through the economy, and the first increase in interest rates was just May last year. Dr. Lowe said the lag is typically a year to 18 months before the full effects are felt. The cash rate would need to increase above 5% for the return to target to be brought forward to 2024, but that would come at the cost of the jobless rate increasing beyond the current forecast of 4.5%, he said. And he considered that monetary policy is a reaction to high inflation, which itself hits all households as real income goes down. This is why inflation needs to be quashed, he said, via higher interest rates. But there are differences across different types of households, and real incomes may grow down the track, possibly, so a more equal experience ahead is possible, at least in theory. Dr. Lowe reiterated that productivity needed to increase to ensure that unit labour cost growth moderated to levels that could be sustained alongside low inflation. Productivity has not increased at all in the last 3 years, but the RBA's inflation forecasts are predicated on growth returning to pre-pandemic rates of about 1% per annum.
Look, we should talk about some of the two risks you raised. I want to just briefly touch on productivity. I guess how delicate is that pathway back in regards to productivity? We've obviously had a significant drop over the last year. What sort of, are we looking for a full return against that? How responsive is the economy going to be to changes in productivity? If we can't turn that around, what happens?
Well, it's a really critical issue. Labour productivity over the past year has declined, but in the year before that it kind of increased a lot. So, the numbers have been distorted by COVID. So I think the best thing to do is to look at the level of labour productivity today relative to what it was in late 19, before COVID. And there's been no growth in labour productivity in 3 years. That's a problem. If that were to continue, it means lower growth in the economy. It means smaller gains in asset values. It means real wage increases are very difficult. It means a smaller pie for government to provide the services that the community wants. I think it's the number one medium-term economic issue. How do we address that? Because we want a bigger pie. We want more resources so the government can provide the services. We want rising real wages and rising real asset values, generating wealth for people. That can only happen if we get better at doing stuff. And at the moment, the situation is not very good. We think that partly that's because of the disruptions of COVID. I know even at the Reserve Bank, COVID disrupted investment plans. We were focused on getting through that period and delaying some investment activities, and businesses tell us they were doing exactly the same thing. They couldn't get the people, they couldn't get the raw material, the capital equipment. So there was a period of disruption. That period of disruption is by and large over now, and we're hoping that we go back to the previous trend before the pandemic. If we don't, we're going to have problems.
Governor, would it be fair to say then, just sorry to jump in, but would it be fair to say then that the government's put some significant focus on IR legislation. Labour productivity is clearly linked. That's going to be a key focus. Whether that legislation has an upward impact on productivity or not is going to be a significant part of our economic recovery.
We should be applying that lens to when thinking about these legislative issues, and different people will have different views on the impact of any piece of legislation on productivity. I'll just remind you that the Productivity Commission this year did hand down a report with 71 recommendations about what we could do. Those recommendations talk to how we organise our schools and universities, the design of the immigration program, the industrial relations system, the support for the digital economy, the way we go about competition law, including zoning and licensing, and the way we're doing the energy transition. So there are a lot of areas we could be looking at, and international reports, when they look at Australia, highlight that the reform of the tax system is unfinished business. So there are a lot of areas that we have the potential to work on. So there's no shortage of good ideas. As I said recently at the G20 meeting in India, the challenge is getting these good ideas through the political process, because most of the changes in these areas are politically contested, and it's hard for our political process, not just in Australia but elsewhere, to implement reform. And so if we don't find ways of overcoming that, then we'll be in a world of very limited labour productivity growth, which means no growth in real wages, no increase in our collective wealth, not a bigger pie for government. So it should, in my view, it should be an issue that dominates economic discussion, particularly when you think about the medium term.
Look, I'm really interested into, how the RBA assesses the productivity settings of the economy. What factors you look at in terms of saying, whether you think, whether there are, particularly right now, it's whether we've got the right policy settings to get the productivity back to that 1% or plus band.
We're experts on monetary and financial policy, not on kind of structural policies. I can only replay back to you what I read in the various reports. And I replayed some of the issues that the Productivity Commission spoke about recently. And the other thing we can do is look at the evidence. And the evidence is the output produced per hour of work in Australia today is the same as it was 3 and a bit years ago. So COVID's kind of disrupted the production around the country, but those disruptions are now over and the level of output per head is the same as it was. But there are a lot of things that could be done, and the issue isn't knowing what to do, it's finding the political consensus to do it. And that's not my area of expertise, that's yours.
Thank you. I guess, when you look at, you mentioned, I think, a variety of factors in your earlier remarks on productivity. Are there any ones that particularly stand out in terms of the ones that you think would make the biggest difference? Appreciate you said, with respect to your comments earlier.
Again, it's not my area of expertise, but I just maybe I could point to 3 things. The first is schooling, education and universities, because the future prosperity of the country rests very much on human capital. We've made ourselves a wealthy, prosperous country, partly through extracting kind of stuff from the ground and growing stuff in the ground, farming and resources. That's been the basis of much of our wealth and will continue to be. But in the next 50 years, human capital is going to be much more important. So getting the settings right in our schools and universities, I think, is critical. Second thing would be related to this is the setting ourselves up well for the digital economy. That relies on human capital as well. And a third thing I would point to is competition policy and regulation, particularly around zoning. Because one of the biggest issues we face at the moment is the high cost of housing in the country. And I think that is debilitating from many both economic and social and personal perspectives. And housing is expensive, not because the cost of building a house or an apartment is expensive. It's the land. The land embedded in each dwelling is very expensive in Australia, perhaps the most expensive in the world. Yet we have a huge continent. Why is that? It's because of the decisions we've made around urban design, housing and planning and zoning. So this is not something within the gift of the federal government, but it is within the gift of governments broadly to make a difference there to the value of land embedded in each dwelling. And I think if we could do that, that would be to the benefit of the society as a whole, not to the benefit of some particular landowners at the moment, but again, thinking longer term, doing something in that space, I think would make a difference to the quality of life in Australia.
Governor Lowe urged policymakers not to succumb to the allure of quick fixes for the housing crisis, warning rent controls would make the shortage of homes even worse over the long term. The warning comes shortly before Wednesday's National Cabinet meeting, where Prime Minister Anthony Albanese will gather with state and territory leaders to secure agreement on housing supply and rental rights. Federal and state governments are under pressure to address soaring rents and the shrinking housing construction pipeline, which is not keeping up with population growth, which of course is very high at the moment thanks to immigration. Newly advertised rents have increased by 11% per year over the last 3 years, making housing costs an increasingly salient political issue and piling pressure on governments to be seen to act. Appearing alongside the incoming RBA Governor Michelle Bullock, Dr Lowe said on Friday that there was no quick fix to the housing crisis and the only solution was to build more homes. There's always a tendency to try and come up with short-term solutions. There aren't short-term solutions here, a confident Dr Lowe told MPs in his final parliamentary appearance before his term ends on September the 17th.
The ongoing source of inflation is in the services sector and rents. And rent inflation is still very strong. At an annualised rate, it's close to 10% in the most recent quarter, and we expect rent inflation is going to stay at least in the high single digits for a while yet. And many services prices are increasing quite quickly. So goods inflation and fuel price inflation has come down, but service price inflation is still high.
In light of your observation about rents, what would your overarching observations be about a range of supply-side policies and measures in the housing market? For example, there's measures to expand supply through a housing accord, through build to rent, but there's also, of course, the Housing Australia Future Fund. And second part to the question, do you have any thoughts on rent controls?
We've talked about this at previous hearings, and I keep coming back to the point that the solution lies in increasing supply. I mean, the vacancy rate, the rental vacancy rate at the moment is the lowest it's been in decades, in some cities the lowest ever. There's been strong demand for rental accommodation, and the rate of addition to the housing stock is low. This year the population Australian population's increased by 2.5%. The number of dwellings in the country has increased by 1.5%. So there's a big gap there, and when there's a demand is strong and supply is weak, prices go up. There's always a tendency, and this is kind of reflection over 20 years, there's always a tendency to try and come up with short-term solutions. There aren't short-term solutions here. The solution has to be putting in place a structure that makes the supply side of the housing market more flexible. And that means zoning and planning deregulation, and it means state and local governments being part of the solution. So we need to have more flexible supply.
But a cap on rents is not likely to boost supply?
No, when housing prices were rising quickly, people were saying, well, we need to give people more money to help with them. And when rents are rising quickly, people say we need to kind of cap the rent increases. So they're short-term fixes that both of them, in my judgment, make the problem worse. So what I would like to see is a longer-term focus on this, because the short-term solutions or the short-term responses are not solutions. And generally giving people more money or capping prices doesn't help with the balance of supply and demand in the market. In most cases, rent controls reduce the incentive to add to supply. So it might help in the short run. It might relieve some pressure off people in the short run. Clearly, that's the case. But I think we've got to keep a medium-term perspective on this. Will that add to the supply of rental accommodation over time? My judgment would be that it would not, and it could actually reduce it. Might help in the short run, but create problems in the long run.
So you've mentioned...
The Greens have said that they will only support the Albanese government's $10 billion Housing Australia Future Fund on the condition that the federal government enacts a 2-year rent freeze, which would require the support of the states and territories. Victorian Premier Daniel Andrews is working on a package that would allow landlords to lift rents only once every 2 years and potentially impose caps on any rent increase. That proposal resembles laws in the ACT, where landlords are limited to lifting rents once per year by no more than 10% of the rent component of the Canberra Consumer Price Index. One of the factors putting upward pressure on rents is a surge in overseas migration, which has caused potential population to outstrip the construction of new homes. Dr. Lowe said there is a big gap there. When demand is strong and supply is weak, prices go up. He was also asked about the mega profits from the banking sector, and he pretty much defended the high margins, but did also encourage customers to shop around.
To you that the banks are profiteering from high rates?
That the banks are profiteering. The bank profits are high, and as we see, the CBA had their $10 billion profit this week, and it's a large number, so I understand why people are interested in that. But I just remind you as well that the banks have a larger amount of capital. The regulatory system requires banks to hold a lot of capital, and the CBA's return on equity was 14% over the past year. In most major economies, banks are earning between 10 and 15% return on equity at the moment, because loan write-offs are low, because problem loans are low, because unemployment rates are very low. So banks in most of the world are earning returns of equity kind of at least 10%. And if you look across the entire ASX companies, the return on equity is averaging kind of 15 or 16%. So, it's high. The return on equity for Australian banking is high, but it's not out of line with what we're seeing overseas or with other companies. So I think that, can I just want to make one more point? I think the issue is, and the pass-through of higher interest rates from the Reserve Bank into deposit rates. And that's incomplete in Australia, and it's, when I talk to my colleagues elsewhere around the world, the same issue is coming up, and the ACCC has currently got an investigation into deposit pricing competition. I can only encourage people who are worried about this issue to shop around and seek a better deal, because there are deposit products out there at the moment that offer full transaction services that will pay you an interest rate of 5%, or in some cases more. So if you don't like the fact that banks are earning so much money, then I encourage you to shop around and make them work harder for your money. And some will pay you more than 5%. So if your bank isn't paying you that amount, I encourage you to look around. we want the banks to compete hard for our money, and we have a role in making them compete hard, each of us, and that is, if you're not getting a good enough deal, go to someone who'll give you more.
And a spike in global gas prices caused by looming industrial action at Chevron and Woodside offshore LNG platforms in Western Australia was not a great concern to the inflation outlook at this stage, Dr. Lowe said.
Do you have any concerns, Governor, that the increase in global gas prices will be caused by the threat of industrial action at Woodside and Chevron LNG plants in WA?
Not at the moment. I mean, the gas prices have increased quite a lot in the last couple of weeks because of the concerns about industrial problems there. But we've got to remember that the gas prices have come down tremendously from their peak after Russia's invasion of Ukraine, and gas prices in global markets were almost back to where they were before that invasion. It would be problematic if industrial relations issues stop production in Western Australia, but at the moment it's not high on our list of concerns.
Having previously apologised for the RBA's failed forward guidance that the cash rate would remain at 0.1% until at least 2024, Dr. Lowe said his one regret was not better understanding the implications of the pandemic. Our mindset was to provide maximum support and maximum insurance to protect against the worst possible outcomes, Dr. Lowe said. And we did that, and it turned out that we provided too much support and perhaps too much insurance and inflation problems now. He said alternative institutional arrangements that the federal government played a more active role in managing demand would be better than the current approach of relying on the RBA, but he conceded that there were political and governance issues with such a shift. No one really managed this because the same issues arise in every country. It was not an Australian specific thing. The central bank's job is to do the difficult things sometimes, and we can do it because we're independent, he said. The next board meeting on September the 5th will be Dr. Lowe's last, after Treasurer Jim Chalmers announced last month the RBA's 8th governor would not be offered a 3-year extension to his term. Summers Bullock will replace Dr. Lowe on September the 18th. Market prices implies just a 1 in 3 chance the central bank will increase the cash rate to 4.35% from 4.1% by the end of the year, and markets are pricing the possibility of rate cuts from May next year onwards. An extended rate pause aligns the RBA with its international peers, which appears to be approaching the end of their respective tightening cycles, but of course it all depends on the trajectory of inflation, and I'm certainly conscious of rising oil prices and those gas prices coming up, and of course we also know that in Australia energy is a real issue with costs rising fast, and of course the other question will be what happens to wages. So there's a lot going on here, and the bottom line is this: I think that not all the heavy lifting has necessarily been done, but they will continue to be data dependent. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.